Cost Accounting, Chapter 10. In Chapter 10, we look at budgets. So the budget process, a budget is a plan. So it's a plan of what we plan to do for the future, either a year, a month, or a quarter, and what resources we need in order to complete those activities and goals. We have the master budget. So that's our original strategy that we start with. So we have a long range plan, which looks at goals typically from a 5 to 7 year period to look at the goals. And then we have a capital or a master budget. So those are our long-term objectives. We're going to talk more about capital budgeting in a future chapter. But strategic budget expenditures are capital budgeting proposals that lead to long-term value and competitive advantage by the organization. We also have to plan out our capital budget proposals and our large strategic budget because those expenditures are often very large and we may want to save for them or find other ways to spread out the costs over multiple years. So that's why our strategic budget and our capital budget are much longer term budgets than an operational budget. Then we have operating budgets and financial budgets. So the operating budgets are the plans for operations, marketing, purchasing, production budgets, any of our personnel budgets, sales budgets, and our financial budgets. Those are to identify the sources and uses of funds for those budgeted operations and capital expenditures. So that's when we're looking at cash budgets. We generally have a budget committee that works on the budget and plans the budget. We have a budgeting period that we plan for. We have guidelines and restrictions on our budget. Then we are going to negotiate, review, approve. If it's approved, then we're fine. And if it doesn't get approved, then we need to revise the budget and come back to it. This process is true around all organizations. Now, when we get into, if you get into government budgeting, that gets a little bit more complicated because a lot of the time that review and approval process involves citizens who get to make their voices heard during the budget process. The master budget is the grand plan of action for an upcoming period. This is all of the budgets together as a whole. It includes pro forma financial statements. So pro forma financial statements are the income statement and balance sheet and statement of cash flows that would exist based on our projections or our budgeted information. It communicates the expectations of the company and what we're going to plan, and then it helps coordinate subunit activities. So if we know how much the sales budget is planned to be, then we can plan our production. And once we know what production is planned to be, then we can plan when to order direct materials for production and how to schedule direct labor. So our master budget is a set of operating budgets and a set of financial budgets. We're going to look at these budgets individually. The first budget that gets prepared is the sales budget. We have a process for creating these individual budgets. First, we want the information contained in the budget. Example, what are our sales for the upcoming period? Then we're going to determine what this information is a function of. So we have the sales budget is a function of budgeted unit sales and budgeted selling price per unit. Then we put the information together. The sales budget is the very first budget that we create. It shows forecasted sales in units and dollars for the upcoming period. So it's both sales volume and what our planned for selling prices are. This is an example of a sales budget for 1 quarter. So we have our sales in April, May, and June for our selling price per unit of $30. Once we have the sales budget, we can prepare a production budget. This shows what our planned production is based on what our projected sales are. When we're looking at budgeted production, we start with our budgeted sales, plus our desired ending inventory, minus any beginning inventory that we already currently have. So when we look at this example, we start April 1st with inventory of 5,000 units. Our desired ending inventory at the end of the month is 30% of the following month's projected unit sales. The sales budget has total sales for May at 25,000 units. So when we make our projected budget, we have 20,000 sales in April, plus 7,500 units, which is 30% of May's sales, minus the 5,000 inventory on April 1st, which gives us budgeted production for April of 22,500 units. Once we have our budgeted production, as we can see here for the quarter, our ending units for April become the beginning units for May. Our ending units for May are the beginning units for June. So we have the production budget for this quarter. We want to produce 22,500 units in April, 28,000 units in May, and 36,500 units in June. Then we can create the direct materials usage budget and the direct materials purchases budget. So we have 2 budgets for direct materials. One is how many direct materials are we going to use based on the production budget that we just made? And then how do we need to plan our direct materials purchases and provide cash for our direct materials purchases in order to meet that level of usage? So this is an example of our direct materials usage budget. We start with the budgeted production. Then we take that times the amount of direct materials we need for that product. That tells us how many pounds we need just for the production, the planned production. We then also start with that same process. We have our beginning inventory, the amount that we need for production, our desired ending inventory, and then that tells us how much we need for production. And knowing how much it costs, then we can plan for how much we need to purchase. So then these materials all follow a very similar thing. We start with our target ending of materials, the materials required for production, and then we have our beginning materials inventory. So here we have the total materials we needed for production, our desired direct materials ending inventory, the total materials we needed minus the direct materials and beginning labor, tells us what our direct materials purchases each month need to be in order to meet those inventory and production goals. Our purchase price per pound times the total amount of pounds we need gives us our total cost of direct material purchases. Once we finish that, we can move on to the direct labor budget. The direct labor budget gives us an idea of how many people that we need to have on staff at any given time in order to meet our standard production. So we have our budgeted output from the production budget. We know how many hours per unit it takes to create a unit, and then we have our standard wage rate per hour. As we can see here, we have 0.5 hours of semi-skilled labor and 0.2 hours of skilled labor per unit. at standard wage rates of $8 an hour and $12 an hour, respectively. So then we create our direct labor budget. We have our budgeted production times the number of hours of semi-skilled direct labor hours of 0.5 hours per unit times the cost for semi-skilled direct labor gives us our total wages for semi-skilled labor for the month. We do the same with our skilled labor. We take budgeted production times the labor hours per unit, take those labor hours times our hourly wage, and that tells us what our total cost for direct labor is needed and how many hours of labor we need to have staffed. This helps the production manager to create schedules and know how many people he has to have on staff each day for production. Once we have those other budgets done, then we can create the cost of goods manufactured and the cost of goods sold budget. Those are prepared after the factory overhead budget is prepared. And then the budgeted income statement and the budgeted balance sheet use information from this budget. So here we have the cost of goods sold manufactured, the cost of goods manufactured and the cost of goods sold based on our projected sales. Then we have a selling and administrative budget. This includes all planned expenditures for selling and general administrative activities. Most of these expenses are considered discretionary and are likely a place for spending cuts. So we need to look at things that, such as customer service, how many people we need on staff for selling, if we have sales commission, that would be included in this budget. Any salaries of our selling and administrative staff would be included in this budget. A cash budget is then created. We determine what our cash sales are and what our cash select when we receive cash from credit sales. So we have here that we have cash and bank credit card sales are 70% of our total sales, and then just sales on credit are 30% of total sales. So we then determine how much cash we receive during the month based on this information. So we have our collections of accounts receivable, our cash sales, cash received from cash sales, and cash received from credit card sales. The cash budget shows the effects of cash on all budgeted activities. We usually have 3 sections that we separate this into. So we have net cash flows from operating activities, net cash flows from investing activities, and net cash flows from financing activities. This cash budget brings together all of the other budgets to identify our cash inflows and outflows so that we can predict if there are any places that we're going to have deficiencies of cash and need to take out a loan. So this is an example of a cash budget for April. We've determined that we have cash at the beginning of the period of $75,000. From our cash budget, we created the operating cash inflows of $539,664. Then we have our cash outflows. We have the cash payments from our direct materials budget, the direct labor amount from our direct labor budget, the projected factory overhead, our projected selling and administrative expenses, and that gives us our net cash flow from operations. We then extend that on. We don't have any investing activities planned, and we don't have any financing activities planned. So our ending cash balance for April would be $84,781.